Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Monday, June 15th, 2026. We're Elena and Marcus.
Right, and we have a massive shift to unpack today. The Middle East is stepping back from the brink, global oil prices are falling sharply, and tech stocks are surging across the board.
Yeah, on the surface, it really looks like a perfect soft landing is materializing right before our eyes. But if you dig into today's data deck, specifically looking at gold and the 30-year Treasury, the bond market is quietly pricing in a decade of structural inflation.
Exactly. So to start off, let us lay out the four critical themes from today's proprietary update so you know exactly what is driving the market. Theme one is a massive geopolitical risk-off unwind.
Right, driven by that weekend U.S.-Iran interim peace deal, it sparked a really forceful tech-led surge in equities.
Then theme two is a very noticeable divergence in global rates. The front end of the yield curve is rallying on reduced rate hike bets, but the long end is stubbornly pushing higher.
Yeah, classic bear steepener. And theme three covers the total collapse of the 15-week war premium in global crude prices. But that is sharply contrasted by some really striking resilience in gold.
Which is a critical signal we will dig into. Finally, theme four focuses on the extreme retail concentration we are tracking in the IPO market right now, specifically looking at the second day of trading for SpaceX.
Moving to today's data, we really need to dissect the yield curve, because the signals coming from the Treasury market are highly bifurcated today.
They are. If you look at the front end, the two-year Treasury yield dropped 1 basis point to 4.07%.
And that move is directly tethered to a massive repricing in Federal Reserve expectations, right?
Exactly. Based on our latest run of SOFR futures, which, is the primary gauge for pricing in central bank moves, the probability of a December 2026 Fed hike just collapsed.
Right. It went from near 100% prior to the weekend down to just 34.7% today.
But looking further out on that curve, the 30-year Treasury yield actually rose 1 basis point to 4.97%. edging dangerously close to that 5% threshold.
Which is a textbook bear steepener setup. And it is happening right as we get some significantly weak regional macroeconomic data. Our desk flagged the NY Fed Empire manufacturing miss this morning.
Yeah, that index completely crashed to 5.7 against a consensus estimate of 13.7.
And for anyone wondering why that matters, it acts as a canary in the coal mine for broader economic stalling. The internal components were even softer than the headline, with new orders collapsing entirely.
Which provides a huge dovish impulse for the front end of the curve ahead of tomorrow.
Right, and timing matters here. Tomorrow marks Kevin Warsh's debut Federal Open Market Committee meeting as chair. A new Fed chair rarely wants to execute an aggressive rate hike when regional manufacturing is decelerating this rapidly.
But let us take a step back and apply the first principles rule here. Because for a standard portfolio, this yield curve behavior might seem, completely counterintuitive.
It definitely can.
We have a peace agreement, oil is crashing, so immediate inflation fears should be cooling. Why exactly does that cause short-term rates to fall, but simultaneously cause long-term rates to rise? What is driving this bear steepener?
Well, from a first principles perspective, you have to view the yield curve as two entirely different discounting mechanisms. The short-term rates, like the 2-year, react instantly to the drop in oil prices.
Because lower oil cools headline inflation fears for the current quarter.
Exactly. That lowers the probability that the Fed needs an emergency hike this year, so the front end falls. But the long end, the 30-year Treasury, is looking entirely past this geopolitical truce.
Right. Bond buyers at the long end are demanding a higher premium because they are focusing on structural realities. Massive fiscal deficits, unrelenting corporate bond issuance, and the staggering capital expenditures tied to the AI build-out.
They simply do not believe a temporary drop in oil cures those systemic inflationary pressures. We are seeing that exact dynamic play out globally, too.
Yeah.
European bonds actually outperform their global peers in early trading today.
Which makes sense. They have a much heavier reliance on energy imports than the United States, so the disinflationary relief from falling crude is priced much more aggressively into their debt.
Yeah, yet even with that relief, the European Central Bank's NAGEL stated today that Eurozone rates remain in broadly neutral territory. Central banks are not ready to declare victory just yet.
On that point, let us look at how this macroeconomic backdrop translated into equity market reactions today. Looking at our daily desk data, the major indices staged a powerful advance.
But underneath the hood, that participation was incredibly skewed.
Right. The S&P 500 closed up 1.65% to 7,554.29. But the real story is the NASDAQ 100. It soared 3.06%, vastly outperforming the Russell 2000, which only managed a 0.72% gain.
Yeah, while the overnight future session looked like a broad everything rally, our internal desk flows show it narrowed very quickly once the cash market opened.
Capital just concentrated heavily into mega cap technology leadership and select consumer discretionary names.
And looking at specific corporate movers, the Magnificent Seven bounced back aggressively. Meta was up 4.2%, Amazon gained 3.2%, and Alphabet added 2.4%.
And the mechanism behind that rotation is key. This group was used as a major source of funds for IPO issuance last week. When institutional investors need cash for a new listing, they sell their most liquid winners.
Right, and once the geopolitical risk cleared over the weekend, that capital immediately flowed right back into those cash-generating assets. We also tracked significant flows into consumer names, catching a bid on pain-at-the-pump relief.
Yeah, Uber and DoorDash were notable beneficiaries today. Lower gas prices ease consumer wallets, leaving more discretionary income, while also improving unit economics for gig economy drivers.
Conversely, we saw an idiosyncratic plunge in Fiserv. That stock hit a 10-year low today following the unexpected departure of its CEO.
Which is a stark reminder that governance risks remain entirely separate from the macro environment. You can get the macro call perfectly right and still lose on micro execution.
Exactly. And then there is the extraordinary retail flow into SpaceX, trading under the ticker SPCX.
Up about 20% today on its second day of trading. Our data desk shows SpaceX absorbed over 70% of all retail single stock net buying today.
Underwriters fully exercised the over-allotment option, issuing more shares than planned to meet demand, and the retail concentration is truly historic.
The ripple effects of that IPO are global. Before the U.S. session opened, our overnight desk data noted Asian indices closed before the SpaceX deal confirmation was fully digested.
Right, which left indices like the Kospi heavily exposed to today's semiconductor re-rating. But once the U.S. market opened, the retail focus stayed squarely on domestic megacaps and this space listing.
Given these concentrated flows, our desk formulated a proprietary tactical setup. We are currently positioned long AI underappreciated versus short low EPS winners.
The long AI underappreciated basket isolates data center beneficiaries with strong upward earnings per share revisions, but that have lagged the broader AI complex in price appreciation. You are buying growth at a reasonable multiple.
While the short low EPS winners basket acts as a hedge, it captures equities that rallied purely on sentiment without fundamental earnings support.
Right. When the market runs on geopolitical relief, every boat floats. But in a regime demanding actual earnings surprises, those frothy, low earnings names are vulnerable to mean reversion.
Understood. So looking at the primary catalyst for all this cross-asset movement, we need to examine the dramatic unwinding of the war premium in commodities.
Yeah, West Texas Intermediate crude fell 487 basis points to 80.75 cents per barrel. And Brent dropped 4.4% to $83.36.
A direct, immediate repricing of the supply disruption risk. And that collapse effectively crushed the energy sector today, which was the day's worst performer.
Our internal tracking shows oil E&Ps down 3.5% and the integrated majors down 4%.
And internationally, it was even more pronounced. The FTSE 100 actually declined 0.39% today, completely missing the global equity rally.
Yeah, it was directly dragged down by its heavy weighting in BP and Shell. They acted as a structural anchor while the rest of Europe rallied on disinflation.
But within hard assets, there is a critical divergence our desk is monitoring. Despite the risk-on equity rally and plunging oil, gold remained remarkably firm at $4,311.69 per ounce.
It is a vital analytical question right now. If the war is effectively over and the Strait of Hormuz is reopening, why is gold holding its ground so stubbornly?
Right, what is the precious metals market seeing that equities are ignoring?
Well, our daily desk data suggests the market is actively hedging bets on the durability of this peace agreement. First, the actual text of the Hormuz Memorandum has not been released.
We are trading on headlines, not legal frameworks. And European allies have openly expressed deep skepticism regarding the Friday timeline for a secure reopening of the strait.
But perhaps the most structural reason for gold's persistent bid is domestic energy reserves. The U.S. Strategic Petroleum Reserve is sitting at a 43-year low of roughly 340 million barrels.
Right. The administration utilized the reserve heavily during the conflict. If this interim deal falters, there is virtually no buffer left to absorb a supply shock.
The market is trading without a safety net, and gold is aggressively pricing in that fragility.
Indeed. And when you pull that entire macroeconomic picture together, the cross-asset signals we are seeing are highly contradictory.
Extremely. Equities are aggressively pricing in a Goldilocks scenario. A perfect, soft economic landing aided by this massive disinflationary tailwind.
But the bond market and gold are whispering a stark warning. The regime takeaway from today's proprietary updates is a picture of profound market complacency.
Yeah, we are looking at a near 5% yield on the 30-year Treasury, and we are seeing high-yield credit spreads aggressively compress.
Investors are putting in strong bids for risky double B and even triple C paper just to chase yield.
At the exact same time, the VIX is subdued at 16.20, and the MBOE index is sitting at a quiet 69.38. The structural issues of sticky inflation and high deficits haven't been cured by a temporary Hormuz deal.
Yet volatility metrics suggest the broader market believes all major systemic risks are resolved, which leaves us with a final thought to mull over before Kevin Warsh opens tomorrow's FOMC meeting.
Is this extreme retail crowding in mega-cap tech and SpaceX actually a safe haven trade hiding in plain sight?
If the long end of the yield curve is correct and we are facing a decade of structural inflation, the traditional macroeconomic cycle is broken.
Right. In a world where money loses purchasing power rapidly and sovereign debt yields 5%, investors might be crowding into companies like Meta, Amazon, or SpaceX because they possess monopolistic pricing power.
They have massive cash-rich balance sheets and act as their own central banks. In a high inflation regime, holding equity in a monopolistic tech company might be the most rational defense mechanism.
So to quickly recap today's core developments, a historic U.S.-Iran interim agreement has temporarily crushed global oil prices and sent the Nasdaq surging. But stubborn long-end Treasury yields and resilient gold prices signal that structural economic headwinds remain deeply entrenched.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.